Welcome back to the podcast. This episode, we're joined by Mr. Eric Nuttall, partner and senior portfolio manager with Ninepoint Partners and the Ninepoint Energy Fund, Canada's largest energy fund with approximately $2 billion under management. Mr. Nuttall's views on energy are frequently sought after by BNN Bloomberg, CNBC, the Globe and Mail, the National Post, and other media organizations. Mr. Nuttall also earned a Bachelor of International Business degree with high honors from Carleton University. Among other things, we discuss the implications of the Canadian federal election, oil volatility, and why Canada needs to build infrastructure projects. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EPAC, the Explorers and Producers Association of Canada. Good morning, Mr. Eric Nuttall. Thank you very much for doing this yet again.
You bet. I think this is our fourth time.
This is the fourth time. Welcome back to this obscure but growing garage band of a podcast.
You were a coffee bean roaster when we met 4-ish years ago. So kudos to you for building this into what it's become. It's incredible.
Thank you very much. It's, like we said, fourth time. Last year was in the spring here. Then the year before that was Toronto. Year before that was online during the pandemic. So,
some real ups and downs.
It's volatile. This convo will probably air in May, so we'll focus on some themes that I think will resonate coming up and get your thoughts on a variety of subjects.
You bet.
That works. So your energy barometer. Last time we spoke, spring 2024, interest was high in energy stocks. Spring of 2025, where is it at today?
I'd say the opposite. I would say sentiment is challenged today. It's no longer an energy issue, right? And now it's concerns about the health of the broader global economy, the direct read through that has for oil demand, less so for natural gas demand. But I think we've seen some short-term weakness in natural gas owing to concerns about, industrial demand and such if the U.S. goes into a recession. But it's been challenged. Like, this sector has been volatile. It's become incredibly complicated, owing to mountains of worries and concerns about, a recession. We've been dealing with that for years now, right? What if the U.S. goes into recession, world goes into recession? What does that mean for oil demand? We've dealt with the vagaries of OPEC plus policy, pivots that they've had, the concerns about spare capacity. And we can debate all of that later on. But this belief that while there's all this excess capacity of, anywhere from 48 million barrels per day, and that's going to create a head wall for the oil price appreciation. And then we've had other sectors performing well. Like, forget an energy investor. A investor can invest in anything. And so the value proposition has to be such so that the risk reward is overwhelmingly in your favor. And as much as I believe that to be from fundamentals and valuations, other sectors up until recently have been doing better. The NASDAQ versus energy outperformed by about 10% last year. That's no longer the case this year. But so it's a combination of volatility, complexity, and relative performance to other sectors, which haven't engendered people to the sector for over a year. Like, my fund has been redeemed almost on a daily basis for the past year. Dave Shabunka, Connate, he's a good competitor. I would assume that he's been experiencing the exact same thing, so that the sector's for sale, and that makes it difficult for stocks to perform when, people on a daily basis need to raise liquidity to meet redemptions.
Speaking of volatility, the week of April 4th, the energy index was down roughly 30%. But April 9th, Trump pauses the tariffs. Oil is back up to $63 within the day.
Sure.
And now we're up again. Index is up again today. So I guess the question is, why so volatile?
Yeah, it's volatile, right? Like, we both lived through COVID, and you remember the days of demand actually imploding. Well, today it's the fears of, the fear of tariffs. What is Trump actually trying to achieve? Is this a blow everything up to just arrive at a 10% baseline tariff across the board with all trading partners? Is it the desire to reshore manufacturing to America, where, an auto manufacturer in Mexico makes $7 or $6. In the US, it's 70. So I don't think anybody truly knows what the true intent is, and therefore how long will tariffs be on the table? What rate will they be at? And what impact that will have on the global economy. So that's feeding the demand narrative. And I would say there's merit to it, right? None of us truly know. And so we can spew off ratios such as, for every 0.1% contraction in global GDP, demand falls 100,000 barrels per day. We have seen Goldman Sachs, Energy Aspects, the IEA, the EIA, everyone's cutting their demand forecasts anywhere from 400,000 to 800,000 barrels per day this year, but everyone's truly guessing. So I think it's the market is trying to deal with that uncertainty. And then what we had a few weeks ago was a seeming pivot on the part of OPEC Plus, where they had outlined a schedule to return curtailed volumes. And then unexpectedly, they announced that in May, they were going to be tripling the amount, so bringing forward months at a time when oil was cratering on demand worries. So for some of us, it really brought us back, like the PTSD reemerged from March 2020, when I remember, coming into work on a Monday morning. Over the weekend, Saudi announced that with demand cratering, they were going to go to their maximum sustaining capacity of 12.5 million barrels per day. And Cenovus opened down 50% on the day. Some mid-caps were down 60 or 70%. It was just staggering. And then they continued to fall like another 80% after that. It was some fun time. So I think that the PTSD from that reemerged, and we're like, okay, well, demand, there's a anticipation of a demand shock combined with uncertain OPEC policy. What are they trying to achieve? Is there some grand deal with Trump? We had the Secretary of Energy visiting Saudi this past week. There's some pictures emerging from that. So is there some behind the scenes deal, or is it different? Is OPEC and certain leadership within OPEC Plus, the members of this voluntary cut, are they trying to instill much better compliance on the part of some chronic cheaters such as Kazakhstan, which is still cheating? Mm-hmm. They never adhered to the deal.
Never did.
And so there's the dual prong. One, a deal is a deal so long as everybody adheres to it. And I believe certain leadership within Saudi Arabia really, really values and honors their word, what they say they do. And that's been reinforced time and time again. And so why should they bear the economic burden when other members are not? And at the same time, down the road, should another curtailment, such as what they struck, need to happen to restore balance, will the market have confidence in that, or will they not? And from the past experience of chronic cheating, lack of compliance barrels, I think the leadership would say, well, the desired impact of another deal down the road would be negated because of circumspect over what their recent experience has been. So I don't think some grand deal has been struck. That's not my impression. I think it's more people that honor their word and others are not adhering to their word, and at the same time wanting to reinstill legitimacy in future deals should future deals be necessary.
One can argue certain members of OPEC Plus never agreed to the deals, though.
Well, no, this was a voluntary deal. OPEC is like a dysfunctional family.
Yeah, exactly.
There's always fighting, there's always disagreements, but at the end of the day, they come to a table and they strike out a deal, and there has to be unity. Like everybody needs to agree for there to be a deal. And this was a voluntary deal, so nobody was being forced with anything held to their head. So, you get the benefit of stability, the ability to invest, unintentionally, maybe a higher oil price than what would have been experienced otherwise. So you have to adhere to the deal. I think that's the background to what we're seeing in recent days. But to your original point, this crazy volatility that we're seeing, it's owing to there's an absolute buyer's strike. How do you deploy capital when there's so much uncertainty? You've seen it, especially in the oil price, crazy volatility. And I do think there's an aspect of the trading market, which I've been doing my best to understand, but it's essentially CTAs and algos, which drive their momentum trading algos. And so if something's going down, they just short the out of it, and they exaggerate a move. And then at the same time, you saw oil break 60 and immediately fell. And I think that's delta hedging. So that's banks that had the liability where producers had hedges with them. And so once you hit that mark, then a bank has to reduce or eliminate their exposure to that. And so just volatility begets more volatility. You effectively have to wash everybody out. And we saw that last week, not to date this conversation, but last week we saw the biggest weekly liquidation in net speculative length in history. So I just think of it as, okay, there's two markets for oil. You've got the physical market and the financial market. Well, we can measure using different software. We have our partners with OilX, which is a part of Energy Aspects. They've got just crazy methodologies to try to track demand in real time. So in April, they have physical demand up 1 million barrels per day. Yet last week, the financial demand for oil, that paper market, imploded by the greatest magnitude in history. So I think we've seen just people get washed out from an equity perspective. Margin calls would have gone out, et cetera. You just have to wash everybody out. People have to capitulate, and then you build from there. And it feels like that's where we are today. It feels like the worst is behind us, but then you have to decide, okay, where are we going from here?
However, short-term volatility can be the long-term investor's best friend. I don't know if you could talk about it. Were you considering buying first week of April?
Yeah, I do. So the decision is buy what? So as a fund manager, you're always worried about fund liquidity. You're always worried about redemptions. You're worried about panic. So vehicles like this, having a conversation that you can share reasons why there's no need to panic. We use Twitter actively for that too, to try to disseminate what we feel is pretty high value key information. And so we can put out tweets, and we're stymied in terms of the level of detail. Like, we're not allowed for compliance reasons to talk about companies or mention tickers, any of that stuff. So we do our best, right, to put out a bar chart, and we've got to cover up the tickers. But what we try to show is business models are very strong. Leverage is very low. Dividends are covered. People can keep their production flat. We're very well protected relative to U.S. shale. So to go back to, okay, you want to take advantage of panic. Exactly. You want to take advantage of fear. That's how we made our brand, I think, in the COVID lows, and trying to see opportunity when others were panicking. And I think we were relatively successful at that. So number one is try to reduce fear, panic, i.e. redemptions, to give you liquidity to take advantage. And we did. Like, we bought, I'm trying to remember some of the trades we did. Like, we bought some more Athabasca, which is a key holding for us, down in the, I think, 350. It's probably up 30% from then. We were adding to similarly beaten down names where some cases we're buying businesses with 50 years of inventory, no debt, CapEx plans sustainable down to 50, and returning all excess free cash flow in the form of buybacks. So yes, were we buying? Absolutely, to the extent that we could. We're typically almost always fully invested, and unless we have short-term severe hesitations. I do kind of kick myself in the behind, because it was Liberation Day where I kind of really felt, okay, this is worse than people thought. And I should have reacted more. Like, we did raise some cash. We had a position acquired, all paper, so it's not really a pure, being taken out. But we had reduced to raise some liquidity on that event, but we should have done more. Like, it should have been, I've been doing this long enough. The spidey senses and your intuition were like, okay, this is worse than people thought. The read through on the global economy is going to be way worse. You should be raising cash, and we should have done more, and we didn't.
Speaking of resilience, I think your estimates are around $50 WTI. Canadian energy is sustainable across the board?
Yeah, that's our math. So to keep production flat and be able to satisfy dividends, on average, producers need $51 WTI. That's using strip Forex at the time. So that, let's say a 1.4 exchange rate and $4 NYMEX. We're probably using about then about $1.30 AECO basis differential. Today we're running about $1 to $1.10. So very defendable. The other component to that is leverage, balance sheet risk. It is funny to draw the parallels between now and March 2020, when you've got uncertain OPEC policy combined with then weak demand, now the anticipation of weak demand. And I was just at a conference last week. We met with 10 of our key holdings. And I recall, like, the conversation today is, okay, so at $60 oil, you're only generating $200 million of free cash flow, not $400 million. Great. Okay, so you can only buy back 5% of your stock. You can't buy back 10. Versus in March 2020, we have tweets to corroborate this. We were doing sensitivity matrices to see, okay, how many months of liquidity do you have remaining? What's the conversation with your bank? Are they going to be pulling the line? Like, what are you going to do? How are you going to survive? So it's just, it's laughable to look at the contrast between then and now. And yet, when I measure length in oil, when I measure how owned energy stocks or are not by U.S. hedge funds, as an example, because we get access to that data, people are far more bearish today than they were then. And so my inclination is, yes, you absolutely want to take advantage of panic and fear and uncertainty, because as bearish as people may be in the here and now for oil, the common conversation we've had multiple times before is I remain very bullish on the medium to long-term outlook. Short-term, it's impossible to be. But at the same time, the world can change with a single tweet. So you can't buy too much into the negativity, but it's made us alter kind of where we want to be exposed. Like we would have the highest natural gas weighting in our fund in memory. Like we would have about a 55% weight in natural gas. We've always typically been oil heavy. That's hurt us the past year, I would say. It benefited us strongly from 2020 to 2024, 2023. But just given the levels of uncertainty on oil demand, I struggle to see how oil stocks will outperform natural gas stocks for the next, 6 months to a year.
This podcast episode is sponsored by Connate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Connate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@connatewater.com or check out connatewater.com for more details. This podcast episode is brought to you by JSG Professional Services, Canada's trusted leader in pipeline construction management and inspection resources. JSG provides competent, qualified, and verified pipeline construction management and inspection resources, supporting Canada's largest pipeline companies from initial development through final execution. Whether your project involves new pipeline construction, integrity programs, maintenance, pump stations, compressor stations, or inline inspections, JSG has consistently delivered experienced professionals to Canada's energy industry. JSG proudly supports Canada's energy infrastructure with competent, qualified, and verified pipeline construction management and inspection resources. Visit jsginc.com for more information. There's the threat of a global slowdown in the economy, but there's also the perception that with tariffs, the demand from the States on Canadian oil will slow down. But how inelastic is the demand for Canadian heavy oil?
It's completely inelastic. So that's why we went out of our way and earlier in the year, why were people selling energy and selling oil stocks specifically? And it was this concern about, well, Donald Trump says, forget the 51st state, all that nonsense, but they don't need our oil. We don't need anything they produce. And then you're like, okay, well, let's look at reality. And PADD 2 refineries, the Chicago area, import in via pipeline 3 million barrels per day every day of Canadian heavy. And so if it's pipeline connected, that means there's no substitution. You can't barge or truck 3 million barrels per day of Canadian of another heavy oil substitute.
Yeah.
Like it's just idiocy. So again, that wasn't a good opportunity where we took advantage of it. At least it was back then, to buy the really beaten up Canadian heavy oil names with no refining exposure because they were just being heavily sold, heavily shorted. So how inelastic is it? Extraordinarily. There is no substitution. A conversation that we can finally have now, I think, is a national conversation about the need to build more oil pipelines to diversify our customer base. It's of critical importance. It's the surest way to raise the living standards of all Canadians while defending our sovereignty. And we'll see what comes out of the election to see if we choose a leader that agrees with that or not. But it's really, I think, is counterproductive to what Trump was trying to achieve. It's a far cry from drill, baby, drill. His belief that there's liquid gold under our feet and production is going to surge. And we really, really fought against this narrative. The contrast is, I think, under his presidency, U.S. production is actually going to peak, and U.S. companies are going to be forced to come to Canada to replace heavily depleted inventory. I think U.S. shale companies have an inventory problem. They've got less of it, and the quality of it is eroding. We can see that in real time. So this U.S. fight that they have chosen is self-inflicting massive damage to them over the long term, because they are jeopardizing a relationship with the safest, most reliable, and cheapest source of oil they could possibly get their oil from, for which they have no substitutions. And the substitutions that they may have are actually falling in terms of supply availability, be it Venezuela or be it Mexico. So it's epic stupidity from an energy policy perspective.
The point is that you can't just It's not like going to the grocery store for a pack of gum.
Not so much. It's a little more complicated than that.
Also on the subject of oil, some small to mid-cap oil companies, dividends of the yield has been at least around 10%. So
crazy.
For years at this point.
Well, not years, but I think of some of our key holdings. We've got a Montney / oily guy that just bought another Montney guy. They're yielding about like 9.5% now. That we've got sustainable down to about 53 to 55, depending on if they cut their growth capex or not. You can buy a royalty stream company now yielding almost 10%. And like royalty companies used to trade at premiums, right? Because you don't have exploration risk. And they've done a decent job of acquiring some assets down in the United States. And so you can get a royalty stream with a very strong balance sheet defendable to 50 at a 10% dividend yield. It's just, it's incredibly compelling.
The perceptions are not the reality. Maybe the header, you could put a lot of that under.
There's a massive chasm between perception and reality right now. And it feels like this is a battle we've fought for so many years. It's getting exhausting at this point. But I think politicians are waking up to the fact that this is not a sunset industry, that peak demand for be it oil or natural gas is no longer within, reasonable timeframes. We had our own natural resources minister, Jonathan Wilkinson, and we'll see if he gets reelected and if he gets that role again. But, we're the third largest oil reserve holder in the world. And you would think our politicians, our policymakers would be the most energy literate. And yet that gentleman declared, courtesy of some scenario-based forecast from the IEA, that the demand for oil is going to be peaking in 2024. So that's what people hear. And yet at the same time, I can point to, okay, we live in a world where demand is record high. We can measure that as of January. Population is going to grow by 25% between now and 2050. It's occurring in areas of the world, Africa, Middle East, where demand hasn't peaked like it has in OECD countries. They consume 3 barrels per person per year. We consume 13. GDP is going to go up meaningfully between now and 2050. Energy demand, all these different things. So it feels like there's more pragmatism entering into the conversation today about the role of hydrocarbons, be it oil, natural gas, coal. A tagline that we've been using is there's no energy transition. Like, what are you talking about? How can there be an energy transition when the demand for oil, natural gas, coal, and even wood as an energy source all hit all-time highs last year, and we see that growing for many years to come. So it feels like there's a bit more pragmatism now, but it's again, going back to this chasm between perception and reality, it feels like those of us who have been out there on the battlefront are starting to win the war slowly. You can see that in pivots, the U.S. presidency and administration recognizing the need for coal, the need for natural gas. Natural gas has gone from the bridge fuel, i.e. it's going to bridge us to, a future of living off of wind and solar and battery, to it's become the fuel now, where you have emerging demand such as, data centers and AI, which I will admit it's a little too popular, but there is reality based upon some of the forecasting. And when you look at the necessity for power 24/7, uninterruptible, like what happens if the wind doesn't blow and the sun doesn't shine? Well, you can't have lack of power for a data center. And so natural gas, I think, has really become the fuel, not of the future, but the fuel of today. There still seems to be resistance to nuclear for some reason. And even if that conversation were to change, the build cycle is measured in decades. So there's this new demand for natural gas, I think, is really quite exciting. And I think policymakers are starting to finally recognize that. So yeah, the chasm is narrowing, but it's still pretty wide as of now.
I guess the long story short is you're bullish natural gas.
Yeah, it's kind of heresy to say. Like we were one of the more notable bears for many years. And up until about 6 months ago, it was the right call. We were always bearish because natural gas, it's always been, abundantly available. Not to date myself, but I started in 2003. And I remember it was 03 or 04. An emerging resource was CBM, coal bed method. It was gas coming out of coal seams and you had to dewater it first. It was just brutal. But it was like the oil sands equivalent of natural gas because it was prevalent. And people would talk about, Horseshoe Canyon, and wells would come on at 150,000 cubic feet a day. So 0.15 million cubic feet a day. Now we talk about wells coming on at 30 to 50 million cubic feet per day. Like the step change is just, it's almost difficult to wrap your head around that owing to mainly technology. So it's always been a resource that's been increasingly available. And at the same time, when you think about demand's historically always just been, cooling and heating. And anytime you get bullish, Mother Nature comes and kicks you in the butt by providing either a warm winter or a cold summer. So what has changed is the build out of LNG. And this probably isn't new to people, but it's just more the magnitude. The US has gone, they're now at about 14.5 BCF a day now. That's going to roughly double over the next 5 years. So that's massive. Canada, we finally have LNG Canada slowly starting to ramp up. Expectation phase 2 gets sanctioned, other projects as well. Maybe we get to 6 in a 20 BCF per day market, like not terrible. I think a forecast like TC Energy, which pipeline company, notably they're typically pretty conservative. They're talking about a 40 BCF a day increase in demand from, I think that's baseline 2023 to like 2035. 40. And it's not AI, it's not data centers as much, little, tiny. Mm-hmm. It's all about LNG. So it's very bearish for global natural gas pricing. It's very bullish for domestic / North American. We look at where can the supply come from and what price does it come to the market at? And we think that the marginal basin is really the Haynesville. A lot of others are still pipeline backed up, the lack of access. Associated gas we see falling off. That's a whole other conversation about twilight of U.S. shale, but we see a production flatlining. So we have other forecasts that it's going to roll, but let's just go with flat. So rising GORs aren't enough to offset flat activity. So you're talking about the Haynesville. And it was surprising at the time, but we've reaffirmed this number that the belief is for the private operators and the public operators, they need about $5 MCF, so call it 5 NYMEX. And it's not just like today. They need the strip because of cycle time. You're like a roughly 9-month cycle time. So you need not today, but you need the 2026 and even the 2027 strip to be high enough to give you assurances that you'll get the necessary economics from that. So if we're trading roughly 350 now, we're shoulder season, economic worries, we think 4 today, but we really think $5 in terms of longer term pricing, so call it 2026 and beyond, to incentivize necessary supply to satisfy LNG demand plus AI and data centers and such. So that's a really positive backdrop. And that new demand source starts to neutralize the impact of a cold summer or a warm winter. So you can be a little more confident in the staying power. Natural gas will always be the widowmaker. It is always more volatile than oil. It is what it is, but at least that volatility should be less going forward.
On the subject of U.S. shale, your opinion is that it's reaching a twilight, but however, there are some influential U.S. investors and leaders that would say that give me $100 oil and we're back where we started. It's all a matter of incentives.
Everything at a price. I admit to that, but to an extent. So let's not deal with like $150 type oil. Let's deal with where we are today, and let's dare to dream in where we were a month or two ago. So coming into this year, we were pretty strong advocates that U.S. shale had entered its twilight, meaning the best years were behind them. And you can debate what the forward future looks like, whether it's a peak, whether it's a plateau. It's kind of irrelevant because the biggest source of supply over the past decade has been U.S. shale. Roughly speaking, the past 10 years, non-OPEC supply has grown by 5 million barrels per day. U.S. shale has grown by 6, and they're a component of that 5. So we saw a while ago, we were early / wrong. We saw a supply crisis coming because there was a mismatch between demand growth and supply growth. And shale really allowed the world to escape that reality.
It was a great thing for society.
It was, but it's coming to an end. And so you look at 2024, U.S. shale grew by its slowest pace since its inception outside of COVID. And so was that lack of spending? Was that discipline? Was it the necessity to return free cash flow back to shareholders to generate free cash flow? Was it permitting? With the Biden administration, all this stuff, we just think it's really Mother Nature. We can see when you measure wells on a per meter per foot basis, productivity is flatlining to declining, depending on where you look in the basin, which basin you look at. We can see gas to oil ratio is meaningfully increasing. And those are the telltale signs of maturity. Like, we're 10 years into this. So when certain individuals like a Scott Sheffield comes out and talks about publicly, and he's not on the board of Exxon because of the SEC, but he goes, look, why did we sell? We had an inventory problem. We were going to be running out of tier one. So that goes back to your original question. We're running out of tier one. I think he said like in 2 to 3 years, and tier two, we had like 5. Well, this was a company viewed to have the deepest inventory of any shale company, and they sold themselves. And so it's true that at a higher oil price, you'll be able to extend the plateau. But where we sit today, at least at $60, we think shale's in the death zone. It's like you're a mountain climber on Mount Everest, and you stay at a certain area, a certain price in this analogy, and you die. That is where we are today. It's $60 WTI does not work for shale companies, especially when they're increasingly publicly recognizing that they have an inventory challenge. And like I gave a speech at the CAP conference last week and did a keynote, and I said, look, one of our big views is we have a shale problem, our inventory problem, and there were shale companies that have flown up to the conference. And so I said, look, I'm not talking about you. I'm just talking about all of your other competitors and your peers. And I got a laugh because like you talk to companies and they will tell you the industry has a problem, not us, but everybody else. So we're at a point now where I think people can be a little more honest in terms of the challenges that these companies are facing. If we're dealing with 80 or 90 or 100, which I think we will, I think it's a certainty, it's just a question of timing, then it will extend the plateau. I don't think you will ever see meaningful growth coming out of shale again. And that has a really, really profound implication on the oil market, whether it's the scarcity premium to be applied on basins with inventory depth and quality, whether it's U.S. policy. Imagine the pivot. You're going from drill, baby, drill to, oh my God, we're peaking. We're actually falling. We just alienated our largest supplier, and they're now seeking alternative markets. It has a very important read-through for OPEC and the power that certain countries within OPEC have going forward. And their ability, like you think about in terms of an oligopoly. I know OPEC members never talk about price. It's truly, that's not one of their desired outcomes. It's more about stability, allowing investment, etc. But at the same time, you can see how this will really provide incremental power in those few countries that have the ability to grow production and decide how quickly and at what price. And there's not a lot of countries in that realm. We've got really Saudi, we've got the UAE, we have Canada. You can debate whether Russia is also in its twilight or not. Before COVID, I think it was 2019, there was a Russian minister came out that actually came out and said we're near peak production, and it wasn't that far off. And you've had lack of investment, so it's debatable. And other countries with resource abundance like an Iran or a Venezuela, well, they have their own challenges, which would be very difficult to overcome. So there's very few countries that have the ability to meaningfully grow. They just, in Canada's perspective, we just have to have our politicians get out of the way and have a framework that reduces risk. And at the same time, you need a pricing regime that makes it attractive enough to take on the risk. Because I think pipeline companies too suffer from PTSD from the past 10 years. So yeah, the U.S. shale twilight, it has a massive, massive implication in many different areas of the energy market.
This episode is brought to you by Astro Oilfield Rentals. Planning your next drilling or completion site or budgeting for an upcoming construction project? Astro has your remote communications and accommodations needs covered. With over 25 years of experience serving Western Canada, Astro continues to expand, innovate, and deliver the best value for your investment. Astro offers a full range of communication solutions, including cell towers, radios, and internet services. Astro's lineup features well site trailers, sleepers, full gym units, medic centers, and custom-built command centers, helping you stay connected and comfortable in even the most remote locations. Visit astrorentals.ca for virtual tours and more information. This episode is brought to you by the Global Energy Show Canada. With new federal leadership and increasing global pressure, Global Energy Show Canada comes at a defining moment for the energy sector. Happening June 10th to 12th in Calgary, this year's event features 5 halls of exhibition, 2 world-class conferences, and a powerful theme titled Canada's Energy Mandate Through 2030. Peter Mansbridge, one of Canada's most respected voices, will lead conversations with Alberta Premier Danielle Smith and executives from Cenovus, Shell, Petronas, and more, driving discussions on investment, Indigenous-led projects, and energy exports. Global Energy Show Canada is where the future of Canadian energy takes shape. Register now at globalenergyshow.com/register. Building Canada. On the subject of what some would call a lost decade.
Some have called it that.
Canada could be the richest country in the world if we just got out of our way and let world-class energy companies get things built.
Did I say that or did somebody else?
I think you said that.
Okay. And it's true. It's absolutely true. It's depressing for those people that get to travel around the world and you visit countries that are similar to Canada in that they've been blessed with just a resource abundance. And you think about Canada, like let's say we're a population of 42 million. We have the 3rd largest oil reserves in the world. It depends on reserve classifications. Natural gas, we don't screen that well unless you count like kind of the 4P category, but we're top decile in terms of natural gas. We have nickel, we've got forestry, we've got gold, we have everything that the world needs. And so why do we live in a world where I just had, call it a friend of mine, his child, he needed to take him into a hospital. They waited 14 hours until they left. 14 hours. I live in Toronto and this stat is recently modestly improved. But if I'm here in Calgary and my wife, let's say she's home with my 3 kids and somebody breaks down the door and is armed and she calls 911. So it's the most urgent priority 1 phone call. It would take Toronto police on average 18 minutes to respond to that phone call. Well, that's why it's lack of funding. So our education system is just a total mess. Our hospital, our healthcare system is completely broken. Our police is so inept, and it's not their fault, where people are literally hiring their own security guards to prevent their houses from being broken into. We do not have to live like this. We have the ability to massively improve the living standards for everybody. And it's not just guys in Alberta. It's everybody, because everybody benefits from our resource wealth. So it's infuriating when I visit other countries where they've successfully leveraged that resource wealth and you see how they live, like Qatar. So, LNG, it is this funny story, but not so funny. It's actually sad, but I got to meet with the Minister of Energy a couple of months after he signed a deal with the German Chancellor. And it was the longest 10-year LNG contract ever signed. The reason he signed that with Qatar is that he had flown to Canada about 6 months earlier. And in our infinite wisdom, our leadership said, well, there's no business case in LNG. And so when you visit a country like Qatar, and there's always downsides to every political system, but you look at them, they have 3 times more doctors than we have on a per capita basis. Like they're not waiting 14 hours for the kid to see a doctor. So it's just, it is infuriating that we just, for some reason as a country, just can't see what we could be and see how we could all be living. So many of the challenges we have, we just don't have to live like this. And I'm hopeful that we will one day have a government in the federal level that recognizes the potential that we have as a country.
Mm-hmm. A few suggestions you've had are to repeal Bill C-69, which prevents any new pipeline or energy project from being built, eliminating the production cap, which cedes market share to our competitors, and to eliminate the industrial carbon tax.
All 3. They're the biggest no-brainers of all time. Let's start with the production cap, or emissions cap, production cap.
Yep.
It's a production cap. It forces production to fall. And I think even the PBO came out with a document that strongly supports that. It is complete idiocy. We produce a product that is in record demand. The demand is going to grow, I think, for many decades to come. And even when demand peaks, whenever that is, supply will have peaked well before that. So there's a view that I hear from certain ministers in Canada. They're like, well, we have to decarbonize to be carbon competitive. That's not the reality of the world. The reality of the world is countries are going to scramble and fall over themselves to secure supply from countries like Canada because they will have no other choice. So this desire to shoot ourselves in the foot and the head and try to stifle our industry with unnecessary cost structures and investment requirements that other jurisdictions do not have is economic treason. And if we continue on this path and willingly give up market share, I get to speak to the energy ministers of countries that are taking it, and they think we're imbeciles to be doing that. And again, I get to visit those countries and see how their citizens benefit from it. So that to me is the biggest no-brainer of all time. You get rid of the production cap. Secondly, C69, you have to get rid of that in order to get anything built in this country again. That's not just energy, it's anything. And so you have different candidates vying. One candidate is obviously, I think he's a little more energy literate and he'd be a great champion for our sector. He's pledged to get rid of it. You have to, because no company, and I know this because I speak to the CEOs of the companies, no company is going to take on the risk if that legislation remains in place. And I'd never mention C58 too, but that's got to go as well, the tanker ban, because we're not going to get a Northern Gateway or a Northern Leg of TMX. We're not going to get anything built with large vessels if you have a tanker ban. It's ridiculous. Mm-hmm. And then the carbon tax, I think, again, technology can solve the problem that we're trying to achieve if that's a problem that we continue to try to attack. Oil sands are 0.1% of global emissions. Canada is 1.5% of global emissions. We could cease to exist. And the build-out of coal plants in China over a couple of years would completely offset the loss of emissions from Canada. We're a very industrious country. We could be a lot more industrious. So this self-flagellation, where we're the only oil jurisdiction on the planet that is doing this to themselves. It's just, if you're the only person doing that, nobody's stopped for even a second and asked, why is that? So it's all of these things, all of these roadblocks, all of these impediments that we've created for ourselves. Like, so much of the conversation is about Trump. There's one person that's saying this is the greatest crisis of our lifetime. Perhaps a little dramatic. The reality is the barriers to us achieving what we could be as a country are all self-imposed.
Goods and services like healthcare don't come from out of thin air. It takes money to pay for it, of which pipelines and increasing GDP pays for. In order to pay for the services and things you take for granted in the country, you need more projects to get built.
Of course.
Of which the energy industry helps pay for.
We're roughly 10% of the economy. That's direct, indirect. We're roughly 25% of our total exports. We're roughly 900,000 high-paying jobs, both direct and indirect. We are a massive component of the Canadian economy. We are the driving force to, again, allow us for people to have drinkable water, to have enough doctors so you don't wait 14 hours, to have roads that don't have massive, massive potholes on it where you bend your rim on almost a weekly basis now, where people aren't breaking into your home and where it takes the police 18 minutes to respond. We do not have to live like this. And the solution is government to get out of the way, remove all of these self-imposed burdens and barriers, and just let industry do what it's really good at. Like, there is an insatiable demand for Canadian resources. Canadian energy, Canadian oil, Canadian natural gas, for all of it. And if we don't take advantage of that, other countries are. And it's not just us, and this sounds cliche, but as a father of 3 kids, like, I really worry about the path that we're on as a country. It's just, if we continue down this path, it's not one where I want my kids, to be on. So it's such a sad moment. And I really, to not be harnessing our resource wealth it's a crime.
Economic development is directly correlated with, human prosperity.
Very much so.
Are you optimistic about a federal leadership change?
I'm optimistic that people want change over the past 10 years. I think it's pretty obvious. I don't think this is sensationalist to say that a conservative government would be much, 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 much more supportive of our sector by eliminating 69, getting rid of the industrial carbon tax, championing the necessity to build pipelines to reduce our reliance on the United States. Like, even with TMX, we're sending 94% of our oil to the US. It's craziness. My city imports oil from the US. It's Canadian oil, but it's got to go from the US. Like, how is this? It's just craziness. So I'm hopeful that we'll see a change. That's my own personal view. If we don't, I think it's status quo. What's said on the campaign trail versus what's reality is too wide. So I don't think we can measure what another Liberal government would look like for the sector. My base case is it's no more pipelines. It's no more projects. It's more of the same, which means there's less supply growth. There's higher pricing. There's more free cash flow. There's more share buybacks. So it reinforces quote unquote discipline. And it just means that if foreign investors continue to stay away, then it's just up to the producer to drive their share price higher on a daily basis by buying back their shares, because they'll have more free cash flow, because there will be less necessity to grow, because we'll lack sufficient egress in a couple of years' time.
When this podcast episode comes out, the election will have occurred. So we'll see.
We'll see what happens.
Well, that's a great update for the sector as of the spring of 2025. If you were to leave the investor with a message coming into the summer, what might you tell them?
I think it's optimism. I've been painted with the permeable brush, which I don't think is fair. When you look at the landscape for both oil and natural gas, it's very difficult not to be, I'm going to say, medium-term bullish on oil, short-term bullish, medium-term, long-term bullish on natural gas. It's just the demand for hydrocarbons is going to grow longer and stronger than the average person believes. And there remains a massive opportunity in that because of perceived stranded asset risk. I can buy companies with decades and decades worth of inventory and get much of that future production for absolutely nothing today. Mm-hmm. We talked about dividend yields. You can buy companies at 9 or 10% dividend yields, sustainable down to 50, with either no debt or very, very modest levels of debt. And so I recognize there is short-term uncertainty, and there are valid concerns about, global GDP, the demand for oil over the very short term. But this too shall pass. Companies in Canada can weather the storm. They're much better positioned for U.S. shale, which would be the first person to fall, and their production loss will balance the market. If we stay at 60, I think production will actually start to fall. And if we're in the 50s, you could fall as much as 1 million barrels per day exit to exit. So there's a self-corrective mechanism embedded in the oil market already. And so again, the concept of buying companies with decades and decades and decades of stay-fried inventory, only modestly growing and using that free cash flow to buy back their shares, it's just that tantalizing dream of the value of that last remaining share, which is a reality if you're patient enough. And for natural gas, it's really the realization that we've gone from a bridge fuel to the fuel, and new demand via LNG or power, electricity, data centers, etc. It's really, really exciting. And so, yes, this is a sector that remains deeply out of favor because it's misunderstood, it's volatile, it's complicated. There are negatives to that, but at the same time, that creates huge opportunity.
If you were to leave a leader with uncomfortable truth on the state of energy, what might you tell them?
Oh, I would say this is not a sunset industry. Stop unintentionally lying by saying that we need to embrace the future of a low carbon world where we need to compete and certain jurisdictions are going to demand a low carbon intensity. The reality is you've got the largest source of supply that's peaking, despite the president thinking they can grow by 3 million barrels per day. There's a reality that comes out of that. And when you think about the long-term demand for oil and the inability of most countries in the world to grow from here, it puts us in such a strong competitive positioning. And so just get out of the way and stop creating so much uncertainty that it costs the sector a tremendous amount of lost opportunity, and it just scares investors, frankly, from seeing the opportunity that we see.
We've got a willing buyer down south. We can be America's supplier, which is good for the Canadian economy.
And increasingly, we've got Chinese demand, we've got Asian demand. There's an insatiable demand for our products, whether it's oil, natural gas, rare earths, nickel, etc. And so there's just, we could be literally the most prosperous country on the planet if we just got out of our own way.
I think that's a good place to leave it. I really appreciate your time today.
Happy to spend the time with you.
Maybe we'll do another spring update 2026.
We'll see what the world brings by then.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. Until next time, happy coffee drinking.